Welcome to this explainer on the brand new Income Tax Act 2025. Whether you're a chartered accountant, a CA student, a tax professional, or a business owner, understanding exactly who has the authority to assess your income is literally the very first step in tax compliance. Today, we're focusing our attention on Chapter 14A of the new Act, which covers authorities, jurisdiction, and functions from Sections 236 all the way to 245. Okay, let's dive right into this.
Picture this practical situation. Your client just got a tax notice. Before you even start crunching the numbers or looking at the merits of the case, you have to ask a fundamental question. How do you know the officer who sent this notice actually has the legal jurisdiction to assess your client's income? You know, jurisdiction is the root of all tax proceedings. If an officer is acting without it, the entire assessment can be challenged and potentially thrown out.
Here is our roadmap for today's explainer. First, an introduction to jurisdiction. Second, the legal provisions. Third, a practical example in action. Fourth, compliance and common issues. And finally, 5, summary and conclusion.
Section 1. Introduction to Jurisdiction.
So Chapter 14A, specifically Sections 236 through 245, is the absolute bedrock of tax administration. This chapter entirely replaces the old 1961 framework, laying down exactly who assesses a taxpayer and what powers they actually hold. While it introduces a very modernized, streamlined approach, you're going to find that it's also smartly maintained some essential continuities to ensure that ongoing proceedings simply aren't disrupted.
Moving right along to Section 2. The legal provisions.
All right, let's look at a really vital component of the new Act, Section 240. This is a big one. It doesn't just casually suggest being fair to taxpayers, it legally mandates a taxpayer-centric approach. Section 240 actually requires the board to adopt and declare a taxpayer's charter. This isn't just a policy document, it's a statutory protection, ensuring that tax authorities administer the law while fully respecting the rights and the dignity of the taxpayer. Now, you might be wondering, how is an assessing officer actually assigned to you or your client? Well, Section 241 states that jurisdiction is vested by directions from the board. Then, Section 242 gets into the practical nitty-gritty. Generally, an AO's jurisdiction is determined by geographic area. If your client runs a business, it's based on where that business is carried on. And what if they operate in multiple locations across India? The law is incredibly clear here. Jurisdiction falls straight to the AO governing their principal place of business.
But things shift mid-assessment all the time, right? Section 243 gives specified authorities the power to transfer cases, but more importantly for us as tax professionals, Section 244 deals with a change of incumbent. If Officer A is transferred and Officer B takes over, Officer B continues the proceeding exactly from where it was left. However, and this is absolutely crucial, the law provides a powerful right here. The assessee can actually demand that the previous proceeding be reopened or that they be reheard before any final assessment order is passed.
We also got to talk about the massive shift toward digital assessments. Under the old Income Tax Act of 1961, various faceless schemes were introduced to reduce physical interface. Now, Section 245 of the 2025 Act formally integrates and legally cements that faceless jurisdiction scheme directly into the law, and as confirmed by the official FAQs on transition, all existing faceless assessment and appellate frameworks are going to continue without any interruption under the new Act to impart greater efficiency and transparency.
Section 3. Practical example in action.
Let's step away from the pure theory for a second and bring this to life. Imagine you're representing a business owner. Step 1. You're right in the middle of a really active assessment proceeding with assessing Officer A. Step 2. Suddenly, due to some administrative changes, jurisdiction transfers over to assessing Officer B. Step 3. By law, Officer B picks up the file exactly where Officer A left off. But here's where you step in for Step 4. Under Section 244, you formally exercise your client's legal right to demand a rehearing. You do this because you want to ensure Officer B fully understands your nuances and arguments rather than just reading Officer A's cold notes. It perfectly protects your client's right to a fair hearing before that final order drops.
Section 4. Compliance and common issues.
Okay, this next part is a real game changer. Perhaps the most critical terminology shift you need to master involves the assessment period. As the official guidance notes and FAQs emphasize, the 2025 Act completely eliminates those confusing dual concepts of previous year and assessment year. Everything is now unified under one single, simple term, tax year. So, for example, the income earned in financial year 2026-27 is simply assessed for the tax year 2026-27. Much easier, right?
So what does this actually mean for your daily compliance work? First off, ensure all your new documentation, forms, and audit reports use the term tax year. Don't let assessment year slip in there. Secondly, you can rest assured that your existing permanent account numbers, your TANs, and any old approvals carry over seamlessly under the 2025 Act. You don't need to reapply. Furthermore, during this transition, the e-filing portal is going to support dual compliance. And remember, as per Section 536, subsection 2, any assessments that were pending prior to April 1, 2026 will continue to be governed entirely by the rules of the old 1961 Act.
Now let's talk about pitfalls and common misunderstandings. Please don't assume that an old notice issued under the 1961 Act just magically becomes invalid on April 1, 2026. It absolutely remains valid. Another huge mistake professionals might make is failing to invoke their Section 244 rehearing rights when a case transfers. Don't leave that on the table. Additionally, you need to be hyper-vigilant when making advance tax payments during this transition. Selecting the wrong year in the portal could seriously delay your tax credits. Finally, just to clear up any doubts, there is zero ambiguity here. The faceless schemes have full, concrete legal backing under Section 245 of the new Act.
Section 5. Summary and Conclusion.
Let's quickly recap our key takeaways from today's explainer. Section 240 legally mandates a taxpayer's charter, establishing a true taxpayer-centric approach. Section 242 clearly dictates that an assessing officer's jurisdiction is defined by geography and the principal place of business. Section 244 is essentially your shield, protecting the assessee's right to a rehearing during a change of officer. Section 245 fully integrates the faceless jurisdiction framework. And lastly, for all compliance moving forward, you absolutely must shift your mindset and your documentation entirely to the new tax year concept.
So, as we transition into this modernized framework, ask yourself a question. Is your firm's documentation and internal training actually fully prepared for the shift to the new tax year concept? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.